And broadcasting.
Good afternoon, and thank you for joining us today. I'm MAPERS board member Andy Hood. A copy of today's presentation can be found on the events page of the MAPERS website. The link to the handouts was also included in the reminder email sent earlier today. Today's webinar, Investing on the Right Side of Change, is sponsored and presented by Wells Fargo Asset Management. Please submit any questions you have for our speaker using the Q&A button located in the Zoom app. Questions will be answered at the end of the presentation. Our presenter will be asking for audience opinion a few times during the webinar. Please submit a response as each question appears on your screen. Wells Fargo Vice President Matt Tepe will now provide some introductory comments and introduce today's speaker.
Well, thanks for joining us today. We appreciate so many of you joining us via this Zoom call sponsored by MAPERS. I'd like to thank MAPERS organization for allowing us the opportunity to host. I wish I could see all your faces. Preferably that would have been in person at a place like Mackinac Island or Shanty Creek or Grand Traverse or one of my other favorite places that we've done MAPERS conferences in the past. But unfortunately not this year. But still great to be with you virtually. We appreciate you taking what is presumably your lunch hour to spend some time with us. As Andy mentioned, my name is Matt Tepe. I'm a director of the Michigan market for Wells Fargo Asset Management's institutional client group. For those of you not as familiar with our organization, Wells Fargo Asset Management is, for lack of a better term, the manufacturing area of the investment management capabilities within Wells Fargo Bank. The institutional client group, which we represent, focuses our efforts on governmental and corporate entities, as well as endowments and foundations. Overall, Wells Fargo Asset Management is approaching almost $600 billion in assets under management, and our institutional presence just within the state of Michigan is approaching $2 billion in assets under management. Some of the people on the Zoom call today are our clients, so we appreciate your business. Thank you for attending. And for those of you that have not met with us previously, we look forward to introducing ourselves sometime soon. With me today, I have my colleagues Joe Conroy and Rick Biziano, who with me have attended a number of MAPERS conferences over the year. And the star of our show today is going to be Ozo Jaculewicz from our Fundamental Growth Equity team. And he's going to be talking about the concept of investing on the right side of change. This is an idea that is particularly important for sponsors of government retirement plans, especially pension plans. Pensions in particular have a very long-term investment horizon. You get the benefits of smoothing returns over longer periods of time from an actuarial perspective, but still funding status is pressured. And the typical government pension plan needs strong equity returns to grow their assets and achieve their investment performance objectives. At its core, the idea of investing on the right side of change is finding those companies that are able to control their own destiny and to grow, regardless of what the economic conditions are outside. The Fundamental Growth Equity team, of which Ozo is part, has become very passionate advocates of this idea and this approach, and has a very unique perspective from my viewpoint on the really monumental shifts that are taking place in markets today, where innovation and disruption are changing business models everywhere. So with that, I'm going to turn it over to Ozo. Ozo?
All righty, well, thank you, Matt. Well, good afternoon, everyone at MAPERS. Thank you so much for having Wells Fargo Asset Management as part of your conference today. As Matt said, my name is Ozo, and I'm a member of a growth equity team that's based in Indianapolis, so not too far from where you all are. We manage roughly $10 billion in growth equities. And so today we're going to be focusing on this concept of investing on the right side of change. And you might think of it a little bit in the context of the growth versus value debate, but I hope I'll make the point to you that I think it actually runs a little bit deeper. than just a sort of style box review. So I want to start with, I'm going to start with a couple of stories before I launch into the slides. And I'm also going to have you answer a poll question in just a moment. The first story I want to share with you is about Zoom. All of us are using Zoom or similar technology a lot these days. If you haven't heard the backstory behind Zoom, it's pretty fascinating, and it's definitely relevant to what we're talking about today. Eric Yuan founded the company. He grew up in China, and when Eric was about 18 years old, he had to ride a train 12 hours each way to visit his girlfriend. And he dreamed on that train of someday creating a technology where he could press a button and see her face. So he came to the United States, came to Silicon Valley, where a lot of innovation happens, and he applied for a visa to be to work in the United States 9 times and was rejected. Once he finally got his visa, he became part of a company called WebEx that was ultimately sold to Cisco Systems. And at Cisco, he led the WebEx team, but found the corporate culture kind of stifling. They weren't really moving fast enough. So he left Cisco and he started Zoom. Now keep in mind, at the time that he started, he was trying to raise capital from venture funds and private investors, and he couldn't. He couldn't raise any external money. Finally, he got the company going, worked like crazy to make the easiest interface for video conferencing. And in 2015, it was a big year for Zoom because they hit 100 million users of Zoom video. You probably know where this is going. In March of this year, after the COVID-19 crisis hit, over 300 million people were using Zoom video on a daily basis. And if you look up the stock price of Zoom, you'll see an incredible amount of outperformance. Zoom and sort of video conferencing and virtual communication are becoming everyday occurrences for us. They're clearly on the right side of change, which we'll get into. So while we're talking about Zoom, Michelle, if you would launch the first polling question related to Zoom. Well, I'm not sure about all of you, but for me, oh, here we go. Here's the results that Michelle is sharing for us. It works great. It's 56% of the response. 42% is can't wait to see people in person. I can certainly relate to that one. And there is a small group out there, I should say, that don't want Zoom at all. Thank you, Michelle, for putting those results up. So I want to share a second story with you again, and then I'll dive into the slides. But the second part of Right Side of Change is more recent, and I found it really interesting. It has to do with Berkshire Hathaway. We all know Warren Buffett runs Berkshire Hathaway. And Berkshire Hathaway has very rarely invested in IPOs in its history. And in fact, it's not invested very much in sort of what you'd consider high growth technology type businesses. As we all know, Warren Buffett and Berkshire are famous for value investing and deeply understanding companies. Well, the man who changed Berkshire Hathaway's mind around investing on the right side of change is named Frank Slootman. Probably a name you haven't heard before, but let me tell you a little bit about Frank. So in 2003 to 2009, Frank Slootman ran a company called Data Domain. This was a storage company. They're one of the early kind of data storage providers. And Frank took $28 million of private funding, and in 2009, sold Data Domain to EMC and returned $2.4 billion to his shareholders. Then Frank, after Data Domain was sold, he went and became the CEO of a company called ServiceNow. ServiceNow, if you're not familiar with it, is a company that is in the cloud software space that very simply has taken the process of having our computers worked on at work and moved that workload to the cloud. So if you call a help desk, for example, and you get a ticket to fix your computer or your laptop, that process was quite cumbersome and expensive for employers. ServiceNow created an automated software, cloud-based, to improve efficiency and cost. So Frank Slootman ran ServiceNow. He took only $6.5 million of external funding. ServiceNow was the second company in the cloud software industry in the history to hit 1 billion in revenue. The first company was Salesforce.com. And 6 months later, the growth accelerated to 2 billion in revenue at ServiceNow. ServiceNow today has a market cap of over $80 billion and is one of the most proven cloud software companies in the industry. Then Frank Slootman went and ran a company called Snowflake. And some of you may be familiar with the name Snowflake because the company really just had an IPO literally a couple of weeks ago. This is where Berkshire Hathaway comes into play. Berkshire Hathaway took a stake in Snowflake that ultimately grew to over 700 million pre-IPO shares. On the IPO, Berkshire Hathaway made over $800 million in profits. Snowflake's a company that's a data warehousing company. And I find it very interesting that Berkshire Hathaway made that decision. Part of it has to do with a dearth of opportunities in the equity markets today. And so we're going to get a little bit more into this now. I'm going to start rolling through the slides, but just think about this. Companies like Zoom, companies like ServiceNow, Snowflake are clearly on the right side of change. So, 1 second here. There we go. Sorry about the lag there. So last year, my colleagues and I, we wrote a paper called Are You Investing on the Right Side of Change? And our goal with the paper was, again, to kind of take a step back. You know, and all the sort of debates that are happening out there around growth versus value and mean reversion and when will value come back. There's all the buzzwords about FANG. And our goal with the paper was to ask our clients and our readers to sort of step away from that and look at the world around us and sort of examine the underlying economy and technology that we're living in. And the argument that we made had to do with this on slide 4. And that is, at the core of what's happening in the economy today is a collision of two very powerful forces. And the first is that the pace of economic growth is decelerating. It's slowing. And I'll get into some more reasons of what's driving that slow economic growth. And the byproducts of that slow economic growth is very low interest rates and low inflation. So we are in this period of time where economic growth is likely to stay structurally low for, we think, what could be many, many years. At the exact same time, colliding on the other side of that force is the pace of technological change accelerating. And this disruption and acceleration that's happening in the economy is now broadening out into more and more industries. And as I'll get to a little bit later, we're finding that this adoption and this pace of technological change is accelerating. So at the center of that collision is this idea of investing on the right side of change. We are simply in a world that is starved for growth. And because of that, there's a scarcity of companies that are on the right side of change. And that scarcity is really at the heart of what's going on in the equity markets. Scarcity is a key word that I hope you take away from the presentation today. So this collision, slow growth and rapid change, is likely here to stay. So let's talk about the side of the Venn diagram about slow growth. And I'm going to present to you what's kind of a simplistic view of GDP, but we think it's also very valid over the long term. Think of output or GDP as simply the labor force, those of us working and contributing to the economy, the productivity of that labor force is what will ultimately produce output. It's those two simple variables, the labor force and the productivity. And if you start at looking at the labor force, what you see on this slide, on slide 5, is that the labor force grew at its fastest rates after World War II. In the 1960s and into the 1970s, you had the arrival of the greatest generation of baby boomers. You had the productivity that came from World War II. And you also had some decades of females entering the labor force. These were massive contributors to higher participation of workers and the labor force. But as you can see, it started to plateau. And since the 70s, the growth rate of our labor force in each decade has been declining. And we will see for the 2020s an even slower level of labor force growth. And some of this definitely has to do with economics, or excuse me, demographics. So on chart 6, some of us know what's going on. You've heard this before, the aging of America. What slide 6 is showing, it's measuring the US population of people under the age of 15 and over the age of 65. And what you see as you get from 2010, move forward, the population of young people as a percentage of the total population is slowing, and the population of the dark purple color of those 65 and older is growing. And it's projected that by 2030, there will be more citizens over 65 in the US than younger workers. So this aging demographics is also arriving at a time where the birth rate in the United States is declining. If any of you have seen statistics around fertility rates and birth rates, they are in decline. So this demographic picture is one that's very difficult to overturn. We think for the next several decades, we're going to be in this environment where the demographic picture is not that favorable to have sort of an accelerating or rising labor force. So this is a structural component of right side of change. The next slide, on slide 7, has to do with productivity. And it's telling a similar story here. Our highest rates of productivity came in the 70s, 80s, 90s, into the 2000s, and then has peaked and declined, really since the great financial crisis in particular. If you look at productivity of non-farm business sector, it struggled to get back to levels that productivity was in decades in the past. And manufacturing in particular, since the great financial crisis, has seen very low productivity rates. So again, we have the labor force challenged with demographics. We have productivity from a changing economy, and now two crises, the great financial crisis and the COVID-19 pandemic, that has compressed output. So if we think of that basic equation of labor plus productivity equals output, what slide 8 shows is that we probably will not be going back to the days when the US economy naturally grew at rates of 3, 4, 5%. We are likely to be in a regime or an era where closer to 2% growth is what we should expect. And that's what's embedded right now in interest rates and inflation expectations. Think about it. we have applied a lot of policy to try to shift this picture. There's been tremendous stimulus and accommodation from the Fed. There's been fiscal stimulus through tax cuts and the CARES Act. We've been doing everything policy-wise to try to goose inflation and growth higher. And it's been a struggle. With the 10-year Treasury bond yield at under 1%, the bond market and the inflation markets are telling you we should probably get used to subpar growth. 2% growth is expansion. Now keep in mind, if the US economy does recover and get back to that level of 2% output, compared to many other countries around the world, that's actually pretty attractive. We're in a world where there are trillions of dollars of negative yielding bonds. And that reflects very, very depressed economic growth in a number of countries in Europe and others around the world. But the punchline is really simple. It's we should expect a new normal of somewhere around 2% growth instead of 3, 4, or 5%. So that's the side of the equation that has to do with slowing economic growth and decelerating growth that we think is here to stay. So this is a key slide on page 9, and it has to do with scarcity, that middle of that Venn diagram that I showed you at the beginning. What we're measuring on slide 9 is we took the MSCI World Index, which is a broad benchmark of equities all over the world, and we went back about 20 years. And we asked the simple question, how many companies in that benchmark could grow their sales, their top line revenues, at a number of 8% or higher, just as an arbitrary measure of what's pretty decent, consistent growth. And back in 2000, what we saw is about 60% of the universe could grow their sales at 8%. Now keep in mind, sales are a little different from bottom line profits. Sales are not as easily sort of managed or manipulated. They're more of a measure of true economic growth for a company. So 60% almost in 2000 was what the universe could produce in terms of sales growth. That line is downward and to the right, where at the middle of this year, only 14% of the index could produce 8% sales growth or higher. Because of that, think about that, 85% of the universe is struggling to produce organic, consistent sales growth. The cohort of businesses that are in the 15% that can grow, they are scarce. Any asset that's scarce, whether it's real estate, automobiles, wine, art, anything scarce appreciates in value. This chart is why the FANG stocks and growth stocks and technology-oriented stocks have had such leadership in the market. They have earned this scarcity premium. We'll get into a little bit more kind of maybe what's reasonable in terms of valuations, but this backdrop of scarcity is what's been propelling growth stocks. All right, so now we're going to shift to the other side of the Venn diagram, which is the accelerating pace of change. And on slide 10, what we're trying to visualize is the internet is one of the biggest technological innovations or revolutions that our economy has ever seen. And when it arrived in the 90s, imagine thinking of the internet like a meteor. And as that meteor sort of hit the earth with this new technology, it created ripples. And the first few ripples had to do with really connecting people to the internet. So this is the original applications that you can probably remember. You've got mail, web browsers, having an internet service provider, AOL, all those kind of memories you might have of the early days of the internet. Semiconductors were kind of the heart of a lot of the computing power that came out of that. The next ring was building the infrastructure to really speed up and broaden out the internet. And so this was laying fiber optic and getting into higher amounts of bandwidth capacity. And it became ultimately the arrival of the smartphone and tablets, which was a massive change, obviously. And so on our tablets and our smartphones, we're all walking around with these incredibly powerful computers in our pockets where we can do social media and e-commerce and all kinds of things that you can see on this slide as a result of mobile devices. So, that was the early stages. We've connected roughly 4 or 5 billion people on the planet to this internet. But now we're starting to move to the rings further out. And these digital applications are entering into really more the enterprise. Originally, it was connecting all of us as consumers, and now we're into a point where enterprises and businesses and industries are all getting connected digitally using internet technology. And so as you spread out this impact, now you're getting into the next generation of technology, things like autonomous vehicles and telemedicine, DNA sequencing, digital payments. All of these technologies are growing in adoption. The final ring on this slide, on slide 10, is when every industry is impacted. And we're moving into that type of phase now. There will be a Netflix, like Netflix disrupted the media industry. There will be a Netflix of manufacturing. Or basically any industry you can think of ultimately is going to face some level of disruption and sort of digital technology. It's already happening. Trucking, manufacturing, healthcare, travel, all of it is going to move in this direction of a digital age. So the same way that Amazon has disrupted retail, you're going to start to see that broaden out to more and more industries. And the companies that invest to embrace that change are going to be on the right side. And what's happening in the equity markets, we have this line here where you're seeing this accelerating bifurcation. If you break apart the equity markets and you see this big bifurcation between companies that are dynamic and digitally native versus companies that are struggling to grow, companies that might be relying more on financial engineering or dividends or share buybacks, for example, you're seeing this widening bifurcation between the two. At the heart of that are the businesses that are on the right side of change. So what chart 11 is showing is that this pace of change is also accelerating. The chart is measuring how long a new technology took to reach mass adoption. So if you go back to the original sort of breakthroughs, like the telephone, it took 35 years for the telephone to reach mass adoption. It took 31 years for the radio to reach mass adoption. As you go forward in time, that window of adoption of new technologies starts to shrink. The PC took 16 years. The iPhone only took 2.5 years. Facebook took 3 years. And now if we were to add sort of the next form of mass adoption, like Zoom video I mentioned, Zoom, now partially because of the pandemic, Zoom reached mass adoption in a matter of months. And I saw a chart the other day about TikTok. I know there's a number of security concerns around TikTok, but TikTok reached 1 billion users faster than any other platform, any other social media, about half of the time that it took Facebook to reach 1 billion users. So this pace of adoption is not going to slow down. And as I mentioned earlier, we're going to see it more and more in the enterprise. Slide 12 is pretty interesting. This is now, I've got a couple of comments about what happened with COVID-19. We wrote the paper about investing on the right side of change before the pandemic. We had no idea COVID-19, was coming. This framework is something that's been on our mind for many years. But look at what's happened since COVID-19. This chart is showing business investment, CapEx, and it's breaking apart physical investments versus digital. Physical investments, investing in property, plant, equipment, hardware, things like that, were already declining, and spending on digital investments was already rising. And look what happened after the pandemic. The pandemic became a fast forward button for investing in digital transformation. And physical investments have become depressed. And we have a couple of sort of more granular themes that show this. I mentioned on the top left what's happened with Zoom and the daily meeting participants, skyrocketing above 300 million per day. Look at what happened with e-commerce. Most of us use Amazon or have retail delivered to us, but not many people knew that e-commerce before the pandemic still only represented 16% of US retail sales. So, there was still a long ways to go. 84% of the market was out there for a Walmart or a Target or an Amazon to go after with their e-commerce penetration. But look what happened with the pandemic with COVID-19. Inflection upward. All of us, of course, working from home and sheltering in place, accelerated the adoption of e-commerce. We have on the bottom left about the Cash App. This is essentially a measurement of, if you're not familiar with Square, Square is in the digital wallet business, essentially. They've got a few different platforms, but this Cash App, this digital wallet that people could receive payments on, send and receive money, receive their stimulus payments from the government, saw an inflection of Cash App downloads. And then many of you already know about telehealth and telemedicine. We've seen an explosion. It was already trending in a growing area, but as a result of COVID-19, more and more of us will get our medical care in a digital way. And these trends, we believe, are not slowing down. So COVID-19 pulled forward years of growth. These trends were already happening, but they were accelerated by the crisis. And I really don't believe we're going back to the past. There will be some new normal. Eventually we'll have a vaccine and we'll get back to some level of normalcy, but these types of trends of digital transformation are here to stay. So I'm going to highlight a couple of investment themes, and then I'll wrap up here in just a few more minutes and see if I've sparked any questions. So our team, the fundamental growth team at Wells Fargo Asset Management, we think a lot about this concept of right side of change. And what we're depicting on slide 15 is an S-curve of growth. And we've identified these 6 themes. We think these are kind of mega themes. You might hear a lot of buzzwords about different sort of niche technologies or niche ETFs or companies that sound super exciting, and some of them are exciting. But on slide 15, we wanted to lay out there 6 what we believe are really durable growth themes. If you're going to invest in the right side of change, we think you should buy companies that have quality business models, that have really big total available markets, and that have room to grow on this S-curve. So these 6 themes are really a lot of our stocks in our portfolio are populated behind these 6 themes. So I've talked about some of them. Digital medicine is going to be a huge theme to invest behind. We have a theme called software talent shortage, and that one's a little bit unique. What that has to do with is as trillions of dollars are spent on digital investments and digital transformation, there's simply not enough software engineering talent in the world to accommodate the massive amounts of demand. So we've identified some really incredible companies that are providing that software talent that are literally transforming industries. I mean, trillions of dollars of market cap are sitting on the shoulders of a fairly small talent pool of software engineers. And that's an area where our population and our skill set needs to grow from an education standpoint. Cloud computing is a massive theme that we think has many, many years of penetration to go. Omni-channel engagement. What that means is companies engaging with their customers in different ways, whether it's digital, online, streaming, or physical presence. The company has to be able to touch its customers in many different ways. E-commerce and digital payments are a huge theme and one that we have a lot of exposure to. Digital payments embedded in websites where we now transact are extremely profitable. They're a toll booth on retail spending. And then streaming entertainment. A lot of our entertainment, whether it's movies, television, video games, are moving in this digital direction. So these 6, call them mega themes, we think have long, durable growth. And they're not fads, they're not sort of flashes in the pan. So I'm going to give you just a couple of examples and then I'll wrap up, and appreciate your time and attention. The first is Chipotle. Many of you probably know Chipotle and maybe visit Chipotle on a regular basis like I do. Chipotle, most of us think of it as a restaurant, sort of a burrito company. We actually think of Chipotle, we've gotten to know the management team quite well. We think of it as almost more of a technology company. And around 2018, Chipotle started down the road of transforming their business. And to do that, they created a mobile application. They wanted to be able to deliver to their customers in any way possible, through mobile orders, through delivery services, and digital engagement. And throughout 2018 and 2019, you saw a steady growth of orders for Chipotle coming through these digital platforms. It got to about 20% of sales, which is, pretty respectable. Look what happened after COVID-19. Now 61% of all orders at Chipotle are done in a digital way. This app that they've built has been an incredible change for the company. They have a loyalty program, which makes customers more sticky. They have ways to communicate and offer promotions. And the profit margin potential from these digital orders is much higher than the traditional brick and mortar. Not to mention, during the crisis, this is a company that had $1 billion in cash, no debt, and no franchises. So Chipotle is in this position to take advantage of disruptions in the real estate industry with a strong balance sheet and a digital penetration that's going the right direction. So we think Chipotle is going to be a winner. Sadly, a lot of restaurants in the United States are not going to survive the pandemic, which, I love small restaurants. So, there's a sadness to it. But the reality is a company like Chipotle that's gone through this type of digital transformation is on the right side of change. I mentioned Square, I think, and I mentioned ServiceNow. I'm going to talk a little bit about this last example on slide 21 in digital medicine. And this has to do with a company called Dexcom. So as I mentioned earlier, a lot of us are going to have our medical care, our drugs, and our treatment eventually move into a digital direction. And that's what's happening in diabetes treatment. Diabetes is a global healthcare crisis. There are, if you look on the top right, we have roughly 400 million globally of diabetes patients, and the expectations by 2045 is that 700 million people on the earth will be managing and dealing with diabetes. The traditional way of treating diabetes, of finger pricks, is pretty intrusive and not terribly accurate. So the amount of global spending that there will be on diabetes will also grow along with those cases, as you see on the bottom left. There's going to be an explosion in treatment. And as eventually as type 2 diabetes becomes more and more treatable, you're going to see opportunities for companies. And Dexcom is one that we have a lot of conviction in. So Dexcom has created software and sensors to allow diabetes patients to have continuous glucose monitoring. And those sensors can speak to an application on your phone that can then deliver insulin when diabetes patients need it. This is a sea change, a massive change in treating diabetes. There's other companies involved in this. It's not just Dexcom. We own a company called Insulet as well. So this innovation that's happened in this category of treating diabetes is creating tremendous growth. Again, think about COVID-19. Many of us now want our medical care on a contactless basis, on a digital basis. Dexcom sensors and software can be prescribed in a digital fashion. So COVID-19 has increased the demand for that type of remote monitoring and treatment. What's really interesting about Dexcom is we measure that they are less than 1% penetrated of their global total available market with very high profitability. This is a company just getting started, and it's seeing great appreciation. So those are two examples, Chipotle and Dexcom, that fit this concept of investing on the right side of change. So I'm gonna pause there and wrap up there, but I would just leave you with this idea. Think of that collision. We're in an environment of slow economic growth, colliding with an environment of rapid technological change. Your equity exposure should be mindful. Are you exposed to these themes? Do you have the scarcity premium behind your equities in your portfolio to ultimately get the compounding that your pension funds and your beneficiaries and your participants need to reach their goals? So I'm gonna pause there, and Matt, if you would jump back on the line and see if we've got any questions.
Sure, as Michelle had indicated, if you have any questions, if you could type those in, we'll get Ozo to answer them on the phone right there.
Well, maybe as we're waiting, Matt, for a question or two, Michelle, forgive me, I got on a roll and I forgot to interject some of the other polling questions. So I'd be happy to, if we want to put up that second question, there you go, perfect. That would be a great way to get our audience thinking more about this.
And Ozo, while we're waiting for the results there, we do have a couple questions coming in.
Okay.
First off, yes, these are valuable companies. Are they really worth 20 times sales is a question that has come in.
Yeah, that's the hot question of the day. Valuations of some of these businesses. Some of them are absolutely worth 20 times sales, but I do think it requires a lot of analysis and selection, careful selection. Not all of the companies that have been dramatically outperforming, this year, for example, are going to be long-term winners. There are some that have gotten even sort of a temporary boost from the pandemic. And we are in an environment where that scarcity premium is so high that I do think there's some crowding. If you look at what's happening, Tesla, for example, Tesla's been an incredible innovation, but I would throw that one out there where there's some crowding in the stock, there's some cult-like behavior, there's a little bit of even sort of a day trading phenomenon that's embedded in some of the valuation of these stocks. We think you do need to be careful. You need to have the tools and the skill to sort of assess the risk reward. I will tell you though, the arguments, especially let's say in cloud computing, the arguments in the last several years that these stocks are wildly overvalued have deeply missed or miscalculated the size of the opportunity. So if I mentioned ServiceNow earlier, it's more difficult when you're a growth investor. You're not valuing hard assets like value investors typically would, and you have to project out into the future and see how an industry may shift. There's not a lot of precision. It's hard to get precision in that. And we have just found that the market opportunities for cloud computing for e-commerce are massive and are regularly sort of underestimated. So as a result, some of these companies, absolutely, they're worth 20 times sales because they will grow into that valuation in time.
All right.
Oh, here's our polling result. Okay, well, good. Looks like some folks think they may need a little bit more growth exposure. And also a 40% of the group that's pretty balanced. That's great. Well, and I want to make one other point here. I'm not arguing that you put all of your portfolio in growth or these companies on the right side of change. I am asking you and your trustees and your consultants to examine the portfolio and really think about that balance between growth and value and what percentage of the companies or the equities in your portfolio are exposed to these really important themes. I think that analysis is important. Matt, are there any other questions that have come in?
Yeah, one more, and actually this is a question to ask you to amplify from me. So you've talked about, frequently plan sponsors think of technology as a sector unto itself. And explain a little bit more about kind of the right side of change concept being not only that this is a technology that's a sector, but how companies, regardless of sector, regardless of area of the economy, are experiencing the impact of technology such that they may or may not be on the right side of change.
Yeah, I appreciate that question, Matt. The right side of change can apply to any sector. Technology and digital transformation is coming to every single industry, whether it's energy, manufacturing. You don't have to be overweight tech or overweight e-commerce or Amazon to be on the right side of change. Actually, I'll give you one other example. A Michigan company, Matt, a company called Aptiv. I believe it's was founded in Troy, Michigan. I'm pretty sure it came out of Delphi. Aptiv, is in the automotive industry. But what's interesting is that as more and more cars move into the autonomous direction and EVs become more and more prevalent, the active safety technology that's so critical to autonomous vehicles is Aptiv has a really, really strong competitive position in that space. 1.35 million people die each year from road crashes, and upwards of 50 million people every year are injured from road crashes. A lot of those happen because of human error. And if Aptiv's safety technology gets adopted more and more in the automotive industry, you'll see those fatality rates and injury rates really dramatically decline. So Aptiv isn't, you wouldn't think of the automotive industry necessarily as a tech sector. Definitely a company on the right side of change. And there's examples in almost every sector, Matt. Michelle, we might, in the interest of time, we might throw up that third polling question and see if people want to chime in on that one, and then we can wrap up if there aren't any further questions. Well, I think we're waiting for the results to sort of collate there. There we go. Well, that's great. Nice distribution of responses, and I absolutely agree with the 48% on innovative companies will likely to continue to outperform. Well, before I turn it back over to Matt, who I think is going to give it to Andy, I just want to say thank you one more time to everyone at Mapers. Thanks for dialing in today. Thanks for hearing our story about investing on the right side of change. We really appreciate your time, and wish all of you a wonderful fall and someday we are going to get back to some normal where you can see each other in person.
I think that was an excellent wrap up there, Ozo. I have nothing more to add, but we appreciate Mapers for allowing us to host this webinar. If anything has intrigued you enough to desire a deeper conversation, please let us know. We'd be happy to get Ozo in touch for a one-on-one conversation and look forward to seeing you at a future Mapers conference. Thank you very much.
I'd like to thank
Thank
everybody.
you, everybody. Stay safe.
I'd like to thank everybody for joining us today. Our next webinar is scheduled for Thursday, October 15th. Registration information can be found on our website. If you're interested in sponsoring a webinar, or if you have a speaker or topic suggestion, please reach out to the Mapers office. On behalf of the Mapers board, we wish you, your family, and your colleagues good health and safety. Thank you.